This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Welcome to the very first episode of Retirement Reimagined. I'm Trevor Garvin, Head of Multi-Management at Net Group Investments, and today we're tackling a question that might sound a bit counterintuitive. Is playing it safe actually the riskiest move when saving for retirement? Joining me to discuss this today is Sunay de Villiers, Multi-Management Fund Manager at Net Group Investments. It's great to have you here today, Sunay.
Thanks, Trevor. It's great to be here, and I'm so excited to get into this topic.
So let's dive right in. Lately, we've seen more investors questioning the foundational principles of investing. There seems to be a growing belief that taking on risk just isn't paying off the way that it used to. What's your views on this?
Absolutely, Trevor, and it's an understandable concern, especially given the market volatility we've seen, which is why we took a step back and we examined the long-term data. And we found that over the past 20 years, South African equities have comfortably outperformed inflation by more than 6% per year, relative to cash that outperformed inflation by only 1% per year. And this natural order of returns also played out across the major multi-asset ASISA categories, where moving up the risk spectrum from pure income funds to high equity balanced funds has consistently rewarded investors with higher returns.
That's encouraging to hear, Sunay, but the last decade has been different, hasn't it?
Yes, it definitely has, Trevor. So when you break the past 20 years into 2 decades, the difference is material. The first decade rewarded risk-taking, but the second, not at all. In fact, over the last 10 years, only global equities really beat inflation in rand terms. But remember, retirement products are limited in how much global equity they can hold. Regulation 28 capped offshore exposure at 30%, with an additional 10% allowance for Africa until the start of 2022. And only at that point was this overall limit lifted to 45%. So it really has been a tough environment for multi-asset fund managers to outperform inflation meaningfully.
Yes, and we've seen that's led to quite a big shift. Investors have been moving away from equity-heavy funds. If we look at the data, over the past 5 years, the high equity prudential category saw 10 billion rand of outflows, while the income category gained over 100 billion, so nearly 10 times as much. So was this move to safety actually smart, Sunay?
We don't think so. So let's take a real-world example to try and understand that question. We named her Thandi. She's 35 years old. She has 1 million rand invested in a preservation fund, and she's also contributing 20% of her annual salary to her retirement annuity every month. She's invested in a high equity multi-asset fund at the moment, but after years of underwhelming returns, she started wondering if she should switch to income funds. So we did the test. We ran the different scenarios.
And I'm interested to hear what you found out.
So we looked at if she switched from multi-asset high equity to income at different points. We tested 10 years ago, 7 years ago, 5 years, 3 years, or even just 1 year ago. And in almost every case, staying in high equity delivered better long-term results. And even when the difference was small, the long-term benefit of staying invested in high equity was clear. The last decade really is the only exception, but only on her lump sum switch. When we look at her monthly contributions, a high equity investment actually outperformed income funds because more of her contributions have been exposed to the recent recovery that we've seen in markets.
So that's an interesting point. So time in the equity markets really does matter. And also we shouldn't forget about the biggest danger of investing, and that is inflation, the silent killer of wealth. So without equity exposure, you risk falling behind trying to beat inflation.
Yeah, exactly. Equities really is the only asset class that consistently beats inflation over time. Remember, an equity represents ownership in businesses that grow and adapt. Bonds and cash have their place, but they just don't offer the same growth potential. So for long-term goals like retirement, equity exposure isn't just helpful, it really is essential.
Well said. I totally agree with that. Thanks, Sunay, for those insights, and thank you to all our listeners for joining us. In our next episode, we'll explore the role of equity exposure during retirement itself. Don't miss it.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.